Welcome, everybody. This is the Thursday evening Viper trading webinar. If you are here to learn about trading futures markets using the Viper tools, you are absolutely in the right place. Tonight's topic is trading that first hour after a market open. And we're going to look at several instruments on the charts. So let's go ahead and knock our standard disclaimer out. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar or other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. All right, with that out of the way, let's get over to some charts. I'm going to start off with crude oil. And let me get over to the screen. Dave H saying I was going to go to Vegas tomorrow, but it's 115. I should just stay at home. That might be a good idea, Dave, unless you like the heat. All right, so this is crude oil. Let me explain what you're looking at here, and welcome if you're on our sort of summer open house thing. If you're visiting us this week, kicking the tires, coming to the live room, checking out our webinars, welcome, welcome. We've got one more day, actually technically two. You'll be invited to the live room tomorrow morning, which you should already have the links, of course. And we do have a webinar Saturday morning. It's part 2 of this one. So it's a continuation of what we're teaching here tonight. And so if you are new and looking at this, let me just give you a quick sort of 30-second back of the envelope explanation of who we are and what we do. We trade the futures markets on an intraday basis. So at the close of every day, we are flat. We don't hold any overnight positions, none. By the way, just as a heads up, there's a huge bump in the margin requirements if you hold futures positions overnight, mainly because your exposure to adverse news risk. You can imagine if you're holding some contracts on, say, gold or oil or even the S&P futures, some monumental thing comes out, somebody bombs somebody else or whatever, who knows what news event. And it could have a crushing adverse move against your position. So the way the brokers hedge themselves is that they bump your margin to like 10x of intraday. So that's really why you want to trade intraday. You really don't want to hold overnight positions. You don't really gain anything by that. Most of you know, of course, we trade crude. That's on the August contract. That's $10 a tick. That's the value of the movement. We trade gold, also $10 a tick. That's on the August contract as well. And in the room, we trade YM, the E-mini Dow futures, and the Russell. And these two are worth $5 per tick. And we'll look at those charts in a little bit. Now, what you're looking at here is, in order to get this data, we're connected to our broker. And this is a 4-range chart. We prefer range bars over time bars. We find that the time-based bars artificially constrain the movement, and you don't get a true representation of what the market's actually doing. And so we find the range has just enough smoothing to not get these jerky sort of 1 minute, 5 minute, whatever, 3, 10-minute bars. And so that's what you're looking at here. And the Viper indicators, so you think of it this way. Here's a good analogy. How many of you have, show of hands, iPhones? And how many of you have some other brand like Samsung? Everybody, how many of you have smartphones? Let's just put it that way. How many of you have smartphones of some kind? Just yes or no. It doesn't matter. You don't have to say which one you have. It doesn't really matter. Just any kind of smartphone. Yes, 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 yes. Some iPhones, some Droids. Okay, so here's a good way to think of it. On your phone, depending on what type of phone you have a. Let me do a visual here. Let me see if I can try to explain it this way. Okay, so let's say that here's your phone. And like I said, it doesn't matter what it is. So in Apple, it's an iOS. So it has an operating system on it, right? And the Samsung phones, the other ones have the other operating system, Android. and what have you. And then on your phone, of course, you have apps. Everybody has little apps that are on your, your sort of home page of your phone or whatever, and you have apps that, do banking, they do whatever, games. So here's how this works. So the phone would be like the Windows operating system on your PC or your laptop, right? That would be like your phone. That's the base operating system. And then on top of that, you have, for the analogy, you would have NinjaTrader. NinjaTrader would be an application, a large application, a trading application that sits on top of the Windows operating system, right? And then what happens is we come along, Viper comes along, and we write scripts in C#, that's the programming language, that sit on top of the Ninja platform. So when the data comes in to NinjaTrader, and it flows through onto this chart, this 4-range chart, our indicators then produce the visual results of what you see here. So for instance, if you didn't have the Viper application running on Ninja, you wouldn't have any of these bar colors. You wouldn't have background colors. There'd be no swings, no power meters. You would just see a raw chart with some bars on it, which is very, very difficult to try to make trading decisions. So what we did is we created these indicators that run on Ninja and display various things. So for instance, one of the more prominent things on here is this band. We have a mid band and 4 bands above it, 1, 2, 3, 4, and 4 bands below it, 1, 2, 3, 4. And we'll explain how you trade those in just a minute. But I'm just giving you kind of an overview. You got background colors. Some of these play into your decision making as far as trading goes, and sometimes they don't. Whenever they don't, is what we're going to address now, which is how you deal with the opening hour of trading. Now, I'm not saying in the first hour you completely disregard bar colors and background colors, because that's not true. You do want to look at that. However, price action rules. That's probably the best takeaway from this. You remember anything from this webinar, price action rules. And what does that mean? That means whatever the price is doing at any given time, that's the direction you want to trade it. So let's look at what the various market conditions are. There's 3 basic market conditions you need to know before you take trades. Okay? I'm going to give you the 3 basic ones, and then we'll discuss subtle variations on them, because this is the basis on which you make your trading decisions. So you have to know if the market is going up, it is said to be in, just state the obvious here, you are in an uptrend. And the way we trade uptrends is we primarily take long trades on retracements or pullbacks into support, right? And the converse of that, of course, is if the market is going down, you are said to be in a downtrend. And the way we trade that is we take short trades on rollovers at resistance. And we'll show how that works. You don't have to memorize all this just in the next 5 minutes. We'll show examples of how this works, okay? I'm just trying to give you a very sort of 20,000-foot view level on this, and then we'll look at specific examples. At resistance, okay? And then you have what's called range bound, also known as sideways. Consolidation is another word used for it. And what it means is the lack of a trend. The market's just not going anywhere. It's flat and going sideways. And there are ways to consolidation. Yeah, there's ways to trade that. Now, there are cases when the purest condition of these 3 market types are in play. And there are times when there is some crossover. So you might be a little confused by that. You're saying, well, Charles, if it's going up, I buy the thing. If it's going down, I short the thing. And if I'm going sideways, I trade the thing. Yeah. Well, but let's look at how this can work. Can everybody see the difference between how the market looks here as an example, and how the market looks here and here. What are the differences between these three pictures? All right, of the three conditions, let's just do a little quick exercise together. Make sure everybody's had their espresso and you're awake. In this area right here, are you going up U, down D, or S sideways in this condition right here? Up, down, or sideways. By the way, I'm only going to give you like 5 seconds to answer these because I got a ton of material to go through. So I'm going to rip these questions at you really quick. And if you can, it's really simple. You just type in a letter. So if you think it's up, you type in a U. Boom. If you think it's down, type in a D. Boom. If you think it's sideways, you type in an S. That's it. Excuse me. It's going to be that simple. Okay. 3 seconds. Time's up. Sideways. This is a side. Excuse me. I keep hiccup. Let me take a sip of tea. Hold on. A bad case of the hiccups kicking in here. Yeah, it's sideways. So characteristics of a sideways market are that there's not higher lows or higher highs, and the mid band is flat. All the bands are flat. They're not stair-stepping down. They're not stair-stepping up. They're going sideways. This is a sideways, excuse me, range-bound market. Here we're going down. Okay, you can see that, it broke support and broke down. Here we're going up. Everybody sees that, right? So characteristic of an uptrend are green background, predominantly blue bars. The middle band and all the bands are stair-stepping, like you're going up a set of stairs, right? And so this is a case where you are taking long trades. Now, in this condition here of sideways, which would be our primary mode of entry to trade the range? Are we getting long from support? L. Are we shorting the top? S. Or are we trading both sides, getting long and short? Long, short, long, short, long, short. That would be a B answer for both. What is the primary mode of entry on a range that looks like this one right here? I'll give you 5 seconds on the clock. This is going to be a highly interactive webinar, so to the extent that you participate in these questions, they're not rhetorical. They're actually questions that are trying to help illustrate concepts in the market. And if you participate, you'll learn more quicker. That's why we do these exercises. 3 seconds to type in an answer. Primary mode of entry is L, getting long from support. S, shorting the top of it. And B, you trade both sides. You're long, you're short, you're long, you're short, long, short, long, short, in the range. One second. Time's up. Okay, this is a condition where I was trying to say where you get a little bit of a crossover. When I say crossover, what I mean is that you have some characteristics of an uptrend that like you have over here in the fact that the background is green. The bars, I think you can make the case, are predominantly blue. Now the midband is sort of flat, but you are coming off of a thrusting up move like this, right? So your primary mode of entry is long from support. Long from support, not both, and not shorting the top. So we have a term for this, and this is the crossover part of the equation here, is that when you are sideways to up, you are still buying support. The opposite of that, of course, would be if you were in a downtrend and you had a range, and we'll find some of these for you in different markets. and you're going sideways, then you're shorting the top. You're shorting the top in an uptrend, but this is not in a downtrend. But this is an uptrend, so you're buying support. Now let's come over here before we go. We're going to skip after we go through this next concept. We're going to skip ahead to what happened this morning in the first hour on oil. Okay, so this is just sort of laying the groundwork. Now, if we come over here on this particular day, and this was the 26th, which is what's today, Thursday, 28, 27. So this was Tuesday. This was actually Tuesday morning. Okay, Tuesday morning. And after about 7:56, so just before 8 o'clock, right as we get ready to close the room on Tuesday morning, this is all Pacific time, and I'm here in California, I'm going to advance this chart. I'm going to ask a very simple question. I'm going to blow this up nice and big. From here, in this time swath of time, just before 8 o'clock at 7:55-ish, all the way over here to 9:30-ish, 9:32, 9:35. I'm going to help you out. You were clearly in an uptrend. We all see that. That's quite obvious. How many long trades are on this chart? You don't have to say where they're at. You don't have to call out any price levels. You don't have to say what time they set up. Just count the long trades on this chart and type in a number. I'll give you 10 seconds for this one. Now we told you what a long trade is, so you should know that. And if you do know that, then you should be able to count them, yes? And this is really important because let's suppose tomorrow morning you get up and you come in the live room and you get in there and oil is doing this. You have to instantly know what you're going to do. You can't, to be successful in futures trading, you can't just sort of, I'll just I'll let the market come to me. Whatever the market's doing, I'll react to it. I'll just have to see what it's up to. If you take an attitude like that, the odds of your long-term success are going to be pretty slim, to be quite honest with you. You have to know ahead of time what you're going to do when it sets up. All right, there are 4 seconds left. We're counting long trades on the crude oil chart. How many are there? I have to tell you, just a word of caution. There's some obvious ones, and then there's some not so obvious ones. So I see quite a few numbers coming in. Robert at 5, Greg at 1, Michael Paul at 4. Michael R has 7. Wow. Paul, Mario. Hey Mario, ciao bella. How you doing there? 9. Wow. Chris. Hey Chris, how you doing tonight? 5. 8 longs from Robert. We got a ton of good answers in here. Toby's got 4, Jim and Randy at 7, and then Dr. Phil has 12. Holy cow. Dr. Phil, you're on fire. All right, time's up. So here again, I'm not going to do this all the way up. I'm going to explain how this works so that when you see this pattern again, it becomes clear to you. Most of the trades that let me start off with a good and obvious one, and then we'll go into the ones that are a little tougher to see and take. Generally speaking, if you're in the live room or you trade it yourself, you know that the sweet spot for taking trades is located right around the midband, just like that. In fact, let me really blow this up because this concept is extremely important to your success. Think of it, I've said this like in webinars probably 30 times. So if you've heard it 25 times, my apologies because I have to say it again. Think of it like a batter's box. And here's home plate right here. Okay, so this is the edges of home plate. Here are your shoulders and here are your knees. And so going right down, if somebody threw a strike right down, whether it's softball, baseball, whatever, they throw it right down the pike, that's a strike right down the middle. That's the location of the midband, and we sometimes call that the sweet spot in referring to trades. Now, there are occasions where the market will just retrace very shallowly and only come down like that, and I'll explain the criteria to get in just a second. And sometimes they'll come much deeper. Sometimes you get markets to come all the way out here, pushing the very envelope of the strike zone itself, but still in the uptrend. The trend is not changing when it comes deeply below the midband. It's an opportunity to take a trade that sets up below the midband. That's all that is. Trend is still up. Now, for the definition of the shallowest retracement that is acceptable, it has to pierce, in an uptrend, you have to pierce line 6 and stealth and close below it. And this is a case where, these are cases where I would say it's too shallow. This is an example of too shallow. That did not count as a trade. This is a case of too shallow, in my opinion. That did not count as a trade. Too shallow, too shallow, too shallow. This is marginal at best. Ideally, you want to see it come down closer to the midband and have a series of bars that close. This is on the cusp. So counting from this line right here, the obvious first long trade was right here. Everybody sees that. We have yellow bars collected right in the sweet spot of the strike zone, coming right down the pike. That is long trade number 1. Most of you got that. Okay? Yeah, repetition is the mother of learning. Isn't that the truth, Robert? That is so true. You got to say something, 10 times to get it sometimes. I'm like that too. Don't worry about it. Everybody's like that. All right. Now, arguably, this could be trade number 2. It is the very lowest end of retracement acceptability in terms of the fact that it did close below line 6 and stealth. Depending on how quickly these bars formed, you could have put a region box or a limit order in here. There's lots of different ways to get in here, but that would be trade number 2. Now, we had kind of a little sideways situation going on over here. You get a little bit of an ABC pattern. A, B, C. We have a couple of tools to allow you to take this trade. We have Object Trader Region Box, which could have been boxed in something like that. This would be long trade number 3. We have a ray tool that draws a ray in the retracement like that, and it would be fill long pretty much on the same bar, which would be the close up of this one right here, long, out of the box, crossing the ray. So the way it works, does everybody know how Object Trader Region Box works? Anybody not know how Object Trader Region Box works? If you don't know, I can take a minute to explain it. I don't. Okay. So as part of the Viper tools, we have a panel that we have built, and it's a strategy. It's semi-automated in the fact that once you set the tools up and put all the conditions in, long, short, targets, trail, the whole thing, stops, then what happens is, let's do an example. Let's look at this first example right here. Let's use this as a good example. This first trade right here. So what you do is you hit the enter button. The region box actually pops up close to where the price is, so it's just sitting there. You position the region box like this to engulf the candles in question. The trend is up, so you would enable inside the thing. There's long only or both. You would enable long only. And then the way this works is that physically, once you enable it, it turns a different color. And when this bar closes outside of the region box right here, this bar, a market order is fired from Object Trader into the market, to the broker, to buy and go long on the close of that bar. Now, the automated part of it is that whatever targets you have in there, let's suppose that you're trading 2 contracts, hypothetically, and the first target is 10 ticks, maybe something like that. And then maybe you have another target that is up here, maybe around 20 ticks. I don't know. Maybe something like that. And you have a 12-tick initial stop that might look something like this. So after the trade fires on the close of that bar, market order is submitted for 2 lot. It's accepted in the market. You're filled long. It will display the trade fills on the chart itself. And then the Object Trader tool manages the trade from that point forward. So for instance, when it comes and gets this 10-tick target, we call it the scalp target. So in the room, for instance, you might hear things to the effect of, Okay, there you're up 8 ticks or whatever, 9 ticks, 10 ticks. Take your scalp target off. Take your scalp target off. So that's what that means. What that means is, okay, you got filled out of the region box long at say 69.24. 10 ticks plus 34, it's 24 is 34. So actually, the 10 tick target would be actually right there. Now, what Object Trader does is it takes the two stops, the two initial stops sitting 12 ticks below here. So 24 less 12 is 24 less 12 is 12. So that's actually sitting physically right here. It's OCO. So once it takes this off, it takes this down to 1. So there's only one initial stop left sitting right here. As the trade continues to move in your favor, you can engage the trail stops and it will trail the market up automatically. And you can set it to trail stealth. You can have an offset from stealth. You can have line 6. There's different parameters. There's 3 different ways to program the trail stops, and we have videos that show how to do that. But essentially what happens is this. You have trail stop, trail stop, trail stop, trail stop, trail stop, trail stop. And if it was too tight, you might have got bipped out here on the close through here. So if you had a trail stop on a runner, you went from 24 to 60, which is 36 ticks for your runner. So you have a scalp and a runner. That's the what I just outlined there is pretty much the operation of almost every single trade you take executes pretty much in that manner if you're going to trade 2 lot. The only other way to do it is if you're going to trade 1 lot, I would strongly urge you to go for the runners and not just scalps. And the reason for that is if you think about statistically, if you are only taking 10 ticks on trades and you're stopping out at 12 and your win-loss ratio is 50%, are you making any money? If you're just taking 10 tick scalps and you're hitting those about half the time and you got 12 tick stops and you're hitting those about half the time, are you making any money? No. At 50-50 win rate, you're absolutely losing money. At least 2 ticks plus commission on every trade. So you don't want to do that. Where your money is made is in the runners. Okay, you want to catch the runners. That's where most of the money is going to be made. Now, if you had a 10 tick and a 20 tick target, the 10 would be taken out here, and then the second one would be taken out at 44. So you choked off the last half of the trade. That's called leaving money on the table. In other words, you had a 20 tick target and the thing ran almost 40 ticks. So each instrument is a little bit different. What you have to do is look at the instrument that you're trading, look at the typical size of moves. So if you say, Charles, I'll tell you what, I've studied oil quite a bit, and I've noticed that after it moves, say, 40 ticks, so let's say the move is overall from, 20 to, 65, 70, so that's actually 45, pushing 50 ticks. I normally get some kind of pullback. Well, then what you want to do is you want to put your targets just inside of that. Okay, so maybe you put your targets like, 35 ticks. So you don't artificially choke off a good trade with a 20 tick target sitting right there. Okay? So that's basically the architecture of how a trade works out using Object Trader. Now, the other way to do this, if you don't use Object Trader, you can still take these trades. You don't have to draw the region box. You can put limit orders in here. And when the bar closes, the limit orders were filled. Now, the disadvantage of that is that you're going to have to manually go in, put your stops in, put your targets in, and then manage the trail and handle the, you will manually be managing the trade, and OT will not be managing it. So there's really an advantage to learning the OT tool. That's kind of what I'm saying. Yep. All right. So is there any questions on how this all comes together? Any questions on how, the various, how a trade executes itself, how we get the targets, how the stop goes in, we do the trail where we get in and out. Let's finish our count and see how many of you got it right. So, okay, so where are we at here? Oh, what just happened? Oh, no. All right, we got a little chart acting up here. No problem. Let me get back to where we were. Okay, here we go. Yeah, we're good. We're good. All right. Okay, back to our account, and then we'll get over to today's market and what it did this morning. Okay. By the way, I'm going to try to cover as many instruments as I can. Whatever I can't get to tonight, I'll cover Saturday morning. So if I don't cover what you want to see, do me a favor. If you come back Saturday morning, remind me, and I'll start with those. Okay, so the count is at 1, 2, 3. Now, arguably, if you didn't get the one that was below the mid-band, you did have another opportunity to draw another box, but I would consider this a secondary entry to a trade that's set up here. So I'm not going to count that as a separate one. You're at 3. Everybody can see the retracement that sat on the mid-band right here. That's number 4. And we had a beautiful retracement sitting on the mid-band right here at 70.11. That is number 5. 1, 2, 3, 4. If you said 5 or thereabouts, or if you said 4, or maybe the size was 6, you had another one there. 5 is the correct answer. I see there's quite a few 5s that were typed in here. So what that's showing me is that you're seeing these trades. Cool. Now, I'm going to show this morning, and I'm going to show how we traded it, and then I'm going to show some other markets, and we're going to work together to make trade calls together as if we're watching a live market tomorrow morning, so you'll be prepared. Okay? Let's fast forward to today. Stand by. Let me get over to today's market, which was the 28th. And then we're going to go back, scroll back to 6 a.m. Pacific, which is the crude pit open. And the equity market's open at 6:30. So in the case of oil, you really want to look for, when we say the first hour, technically from its open would take you through 7. However, there's a lot of movement that happens in oil between 7 and 8. So technically speaking, you're going to want to look for trades from, basically as long as the live room is open, taking you from 6 a.m., actually 5:55. So let's look at, let me bring the chart up here. And you can take a look at it. So here is what oil looked like at 5:55 this morning when Gary opened the live room. Would be somewhere about right in here. Okay. Now you remember what I said. You remember what I said. What did I say? That in regards to background colors and bar colors and things of that nature, you have to be prepared to go either way in the first hour. That's important to remember. You can't get married to a trend direction. Now, why am I telling you that? Here's why I'm telling you that. It's easy to get sucked into a market condition, for instance, when you see something pre-market that looks like this. So when 5:55 comes along 5 minutes before the crude pit open, what would your bias be based on this? Up, down, or sideways? Remember our 3 conditions? There's 3 conditions. What would your bias be in the pre-market on oil? If you're looking at it, here, you're looking back, it's 10 minutes to the pit open and your market looks like this. Do you have a bias up, down, or sideways? Yeah, down. Based on what you're seeing going into the open. However, is it possible? Is it possible that at the pit open, things could change? In other words, when the crude pit opens, and this is true of equity markets too, and we're going to look at this, is it possible that you could get some consolidation around the mid-band that could occur, and in fact go either way, perhaps up, perhaps down, and we need to be prepared for that. So what I'm saying is, for the most part, you want to be prepared for the market to reverse and go the other way. So at the time that this forms going into the pit open, you have to keep an open mind and be prepared for both directions. I mean, it's not unusual in some markets, and very volatile markets where there's huge swings up, huge swings down, flying all over the place, that you could get conceivably a half a dozen trend changes in a day. So what I'm saying explicitly, to be clear about this, is you got to be ready to take the other side of the market. Otherwise, you can miss some big moves. Now, I'm going to advance this chart into the pit open, and you type in an L when you think you see a long trade. Ready? Everybody ready? I'm going to advance the chart. In fact, I'm going to blow it up and make the bars even bigger than what they are so you can clearly see what's going on. I'll help you out. I'll help you out. I will tell you it is a long trade that sets up. So that is off the table. You don't have to worry about shorts. Don't call where it is or what time. So what you got to do is when you think you see a long trade that you say this is tomorrow morning and it plays out just like this, where you would take a long. Ready? Here we go. Remember, when you see the the long trade set up, type in an L. Here we go. Okay, there's a pit open, right? Or Gary's opening the room. 5:55. Gary's opening the room right there. Live room's open and you're in it and you got your charts up. Here we go. Here's 5:58. Room's been open for 3 minutes. Typing in a long when you see a long trade. Remember? That's what we're doing here. Let me blow the bars up a little bit more. Okay, there's 5:59. Okay, there's 6 o'clock. Crude pits open. Oh, the screen's frozen. No, nobody typing anything in. I'm like, is there anybody? You guys awake? That's because I had the pause on. I'm sorry. Oh my goodness. All right, here. Okay, there we go. All right, nothing's moving. Okay. Sorry about that. My apologies. My apologies. Let's start this over again. Okay, here we go. 5:47, 5:48. Okay, there's the line. Crude pits open. Okay, here's the first couple of minutes of the crude pit opening. Or Gary, I'm sorry, this line is Gary opening the live room. Gary opening the live room. Yeah, at 5:55. So that's the room being open now, and you're in the live room. Okay, 5:59, 1 minute to pit open. 6 o'clock, pit open. 6:01, 1 minute into pit open. 6:02, 2 minute into pit open. 6:03. 6:04. Pit's been open for 4 minutes now. Remember, I helped you out. I told you it was a long trade you're taking, right? So you don't have to worry about what direction you're taking. You just type in an L when you think it's set up. Okay? All right, here we go. 6:04. This is 6:06. 6 minutes into the pit open. 6:13. So it's another 6-7 minutes. All right. I'm going to stop it there. Okay, now here's how this went. In looking back at your responses, there was a group of you, a small faction of you, if you will, from the whole team here tonight, that typed in L's when these bars were forming right here. You're what I would call sort of the early adopters, the early birds. Because what you were probably noticing here was that the short trade has stopped out from the pre-market session, right? The market had moved like this, changed the color of the background, and the bars had started to form turn to a blue color, and that there was a sort of a little bit of a base being formed of support right in here that was holding. In other words, what I'm saying is this never happened. This whole breaking of support and going back down, you were never, if you drew the box like I showed, it's right here, you were never filled short. There was no short. This never happened. Okay? So that was the answer to your bi-directional question. Remember at the beginning, we said you got to be prepared for this to happen. Yes? Up or down. The bottom of that box was that support was never broken, so you never got short. However, this did happen. So if you drew, depending on when you drew the box, you were probably filled long on one of these two bars right here using Object Trader or a limit order. Either that bar right there or this bar right here. Market order long at the close of the bar. Okay? That I would call you the early adopters, and there was quite a few of you that typed in an L as these bars were forming, and that was the earliest possible position to take a long in the first like 2-3 minutes of the pit open. Now, some of you started to type in L's on this move. Now, that is not correct. I just want to be clear about this, okay? That is not correct. Here's why. In an uptrend, what we discussed was the fact that you have this notion of price action, which is thrust in the trend direction, changing the background green, predominantly blue bars, and you have retracement. We are not, whenever you hear us quoting in the live room and talking about it in webinars, do we say that we're thrust traders? Viper Trading Systems is a thrust trading company. Whenever the market thrusts in a given direction, that's where we fire a market order and get in. Is that how we trade it? Thrust traders. So it would look like this. Well, I don't know about that box right there. I need to be more convinced. I need to be more convinced that the market's going up. I need to see some more movement in a given direction, and then I'll pull the trigger. Oh, wait a minute. Hold on. Bars are going up. Bars are blue. Man, look, we're taking out that swing. Holy cow, we're way up here. And then next thing you know, you're convinced the market's going up, and you fire a market order up here. How many of you do that? How many of you do that? Just don't be ashamed. Hey, listen, I used to do this for years. I used to do that all the time. And I would wait to get convinced. Okay, now I'm convinced. I am now convinced that this thing is going in. I'm going to miss it. It's going to shoot all the way back up here. It's going to take out 97 and it's going to go to the moon, and I'm going to miss it. I better get in. You fire an order here, and next thing you know, it's like every time you get into a market, it starts pulling against you, and you're upside down. So you start feeling some heat. Wicks at top. Maybe you got filled like right here, and you're filled like 2 ticks from the very apex of this thrust. You're sitting way up here at 65, right? All right, it's pulling and low. I'm feeling some heat. Oh, darn. Oh, darn. Oh, goodness. I got my stop. It just took my stop out. Why does it always do that? Every time I get in, it's like the market knows that I'm in. It rips against me, takes my stops out, and then next thing you know, it bounces and goes we're in my favor. Now here's why that is happening. The psychology of it is this. You have to train your mind to understand what the market direction is, and then train it to look to buy support in an uptrend, right? Not the thrust part. In an uptrend, the thrust part is up. When a market is doing this, and when it gets to a certain point, profit taking occurs, and that's why you get the retracement. It returns to an equilibrium where buyers and sellers become equal. Again, sometimes it sits there for a couple of bars, sometimes it'll sit there for 10 bars. When the buying resumes, the up thrust continues, which is this right here. And this is what you want to catch. So if you've been stuck in that rut of getting in the thrust moves and constantly getting stopped out on the pullbacks, it's because you're getting in the wrong place. You're getting in on the thrust part. You need to get in on the retracement part, which is this box right here. A lot of you typed in long when these bars formed, and that was correct. So there was actually 2 good entries. One here, early bird adopter. Second one was here, filled long on this bar right here. Excellent. Most excellent. Everybody did extremely well on that exercise. Total gold stars to everybody. All right. Okay, let's do this again on oil. Let's look at a couple more real quick because we're going to run out of time. Let's do this one. Let's do this at least 1, maybe 2 more times. Okay, are you ready? We're going to do it again. I'm going to advance the chart. And when you think there's a long trade, you're going to type in an L. I'm going to start from a position of right here. Now, this would have been right around 7 o'clock. How you know you're not getting into a false breakout? You don't. You don't always know that, Dave. I mean, there are times where you're going to get false breakouts, where you're going to get filled, on a region box. It's going to pop up a couple of ticks and rip in your face. And maybe we'll look at a couple of examples on how you can deal with that. The easiest way to deal with it is hit market close and just get out. You can see if a market comes up and it starts to just sort of move in your favor and you're up a tick, couple of ticks, you're up $5, $10, whatever, $20. Next thing you know, you're back to break even. It's coming below your entry. It looks like it's going to rip the other direction. The quickest way to solve that, if you get into a situation like that, market close. Babonga, I'm out. You don't want to always have that thing rip all the way down and get your initial stops. You don't want to do that. Okay, if you can get out where it comes back in your box and you're not feeling good about it and you're down a couple of ticks, Dave, H, and everybody who's wondering that, that's how you get out. Are you ready? Once again, we are typing in L's when we think we see the trade set up from this morning that could occur again tomorrow. Here we go. Okay, now we're right at 7 o'clock. We're about an hour into the crude pit open, and we're watching and trading crude oil. There's 701. When you think there's a long trade, you type in an L. 702. 703. 704. 705. 706. 707. And 711. Interesting mix of answers on this one as you observe this chart and typing in L to represent the long trade entry. There was a small handful of you, and I won't name any names, who typed in an L when these bars were forming up here. Okay, and that's not correct. If you're still typing in bar, if you're typing it, thinking about getting in trades, then you're flying in the face of what we just talked about like 2 seconds ago, which is buying into the thrust. In a long moving, in an uptrend where you're getting long, this is the thrust portion of it. Now, some of you typed in. There's another small handful of you that typed in L when these bars formed right here. Now, is that correct, team? Yes or no? Is this retracement to here a legitimate long trade entry? Yes or no? Five seconds on the clock. This box, is that considered in our description earlier of the strike zone and the criteria to get long in an up move for the shallowest of retracements? Does this box meet that criteria? 3 seconds left. It's a Y or an N. It's a yes or a no. And you need to know right away. You need to just go bam, yes, bam, no. 2 seconds left. One second. Time's up. I don't know any other way to say it, but hecka to the no. Hecka to the no. All right. Didn't we say that we had to pierce and close below the stealth line and the line 6? This bar just barely did it by a tick. The minimum retracement for an entry on this particular pullback would have to come and close bars down in this area right here. It's too shallow. This is not a legitimate long trade entry. That is a heck to the no. That's not deep enough. Now, you could make the case, oh, Charles, it worked. It worked out great. I mean, you caught the tail end of the trade. Well, that's true. In this particular case, it was a powerful uptrend, and you might get lucky, and you might get a trade. You might get a 20-tick follow through here. No question about it. There's a lot of times where this will be just shy of the top. You'll bip up a couple of 3, 4, 5 ticks, and then gabamba right in your face. So remember, the shallowest has to come down below 6 and close below stealth, and ideally have a collection of bars sitting down in here, and then break back up. All right. Now, most of you typed in an L when these bars were forming right here, and that is correct. Now, there was a question earlier about how to draw the boxes. You know what I'm going to do? I'm going to break out a part of Saturday mornings, because we're getting a little long in the tooth here. I'm going to break out a portion of Saturday morning's webinar to address the box issue. I don't have enough time to do that right now, but in short order, what you want to do is when you're sitting on a support area like this to take the long trade, you're going to look for the wicks and bodies of candles to the left, and then normally you're going to get at least 2 or 3 candles that wick and form support. So let me show. Let me look at it. Just take a second to show something a little bit differently. I start looking at candles when they get down in this area right here. These 3 candles are the first things I look at right there. If you want to know how to visually see where to start positioning, how you might draw your box and get in, I start to look at these candles right here. And then I start to look at where they're basing out and finding support. In this case, it's wicking the midband perfectly right here. See it at 13, 15? This is the bottom of your box. Now, pop quiz. Pop quiz. Make sure you're still awake. Does the bottom of a region box that's in an uptrend matter? In other words, where the bottom of this thing is in an uptrend with a region box drawn as I have it shown here, does it matter where the bottom is? 4 seconds on the clock. N or Y. Does it matter? Does it matter where that is? 1 second. Time's up. No. No, it doesn't, because remember, in an uptrend, we are in Object Trader, we are going long entry only. There is no short entry. Long entry only, so the bottom of the box does not matter. And the reason we do that is that there is occasion where bars will close down into here. You do not absolutely want to be sucked into a short. You may be at cases where you have to actually redraw the box, say, down under here. If you were not filled long, you have to come down here and maybe reposition the box, but you're absolutely not getting short because you're long only. Now, I'm not saying you willy-nilly just put the bottom wherever you want it. It's got to be a nice, symmetrical, good region box. And I promise you, just remind me on Saturday morning to spend a little bit more time on that, okay? Excellent. Let's do one more, and then we'll wrap up. And everybody's getting pretty good at this. I think you're getting your trade seeing skills are getting honed. You want a little bit tougher one? It's kind of lobbing up some softballs to you. Maybe you want a hard one. You want a hard one? Let's take a vote. Who wants some hard ones? How about a tough one? Yeah, bring it on. Okay, all right. You want it? You want the hard ones? All right, here we go. I'll get a hard one there for you. We'll get one that's really tough. Tell you what, let's bring the Russell up from this morning in the first hour, and we'll do a couple over there, and then we'll wrap up. Let me drag the Russell chart down. Give me 1 second here. Because it was a little bit tougher. It wasn't as clean. And I'll make the questions just really straightforward. I'll just you're gonna, in these 2 examples, I'm not going to advance the chart and have you call the trade. I'm going to have you call what direction you're going to take, either long or short. Oh, hey, Robert, no problem. No problem. Yeah, absolutely. Preparation opportunity, so bring it on, says Greg. All right, I'll bring it on. Okay, here's the Russell. And we're going to start at the open, and then I'm going to advance it and pause it, and you're going to make a trade call. Just like you're looking at it tomorrow morning, and you're trading it. You're trading the Russell. This is RTY. Russell E-mini futures, $5 a tick, September contracts on all the equities. Are you ready? Here we go. Here's the pit, no, it's not a pit. It's an equity market open, but that's not where the trade call is. So hold on. I'm going to advance the chart, and you're going to make the call. Okay, I'm coming. There's 634. Is this trade long or short, or both? 5 seconds on the clock. L, S, or B. Tomorrow morning, you wake up. It is 6:37 a.m. Pacific time. You have your charts. You're all teed up. Your templates are ready to go. You're locked and loaded. Object trader. You had a good sleep. You had a cup of coffee. You're wide awake. You are ready to trade. Long, short, or both. 3 seconds on the clock. I'm referring to this area right here. What is that? Long, short, or both? Let me advance a little bit more as you ponder the question. Advancing a little bit more. Now you're at 6:39. It's been sitting up here for 3 minutes, dinking around, dinking around. Are you short, long, or both? This is what you're watching happen right here. Look at the clues. Look at the clues on the chart. What are the clues telling you? There's clues everywhere. It's like breadcrumbs. You're lost in the woods. Time's up. Now, when I first showed this cluster of bars right here, many of you said trade both, and I can understand why. Because at the time that this formed, let me go back. When I paused, the first pause, it looked like that. Many of you typed in both, and I can understand why you did, is because there's sort of a conflicting point of view on what could happen from here. And here's why. We have evidence through this thrusting action here that took out support and changed the background red, the mid-band stair step slightly down, and we are kissing resistance, that this could very definitely roll over and break down and go short. So many of you typed in short, S for short, and you turned out to be correct. Some of you probably looked at this scenario and said, well, it's coming off an uptrend there, Charles. It's quite possible that this thing could break and go back up like that, and you are correct. So it's perfectly acceptable to have short only or both. If you typed in short only or both, you were correct. I would not, under this scenario, at the time that it happened, 7 minutes into the equity market open, go long only. Mainly because of the stair stepping down, the red bars and the red background, and it's hitting resistance and looking like it wants to roll over. Then another handful of you typed in short or typed in shorts when you saw this price action breaking down, in which case you were looking to get short from another roll right here. Kissed it twice. And you were correct. Watch how this thing panned out. Was there a third entry? There's your 2. Real quick. Okay, I'm advancing it. There's 639, there's 640, 642, 643. Is there another entry? 643, yes or no? 2 seconds. 1 second. Time's up. Yeah, what is this right here? What is this right here? What is this right here? Kissy kiss kiss on the midband. Hello, my little friend. Now, by this point here, I'll help you out. By this point, you're pretty clear you're going down. This would be short only right here, in case it wicked back up and sucked you into a long that you wouldn't want. So that's very definitely a short only box. And then she just falls off the map. We took this trade in a live room, and it made very, very good money. In fact, let's just show you how much perhaps you made on. If you're close short at 42 even, it didn't really stop out until all the way down here at 36. This was a 60 tick drop. One contract would have been 3 bones. 3 bones for you right there, just like that. Ba-bamba. 2 lot for the drop, 60 ticks, 600 bones, 6 bones. Some of you, if you had a $500 profit target for the day, would be done. We call that one and done. You're literally like 45 to 50 minutes into the trading session, and you are done. One trade. Bamba. Done. That's what you want. 1 or 2 and done is our mantra. Now I'm almost done. We're out of time. I'm running over. That's okay. I'm going to advance it to trade call number 2, which set up at 6:52 a.m. Pacific. I'm going to blow it up here so it's real clear what's going on. 6 bennies. That's right, Robert. 6 bones in the pocket. Well, technically in your trading account, but that's how it works. Okay, last question. Last quiz of how to trade the Russell this morning. We are looking at this area right here. Same question, 5 seconds on the clock. I'm circling the area with my cursor. Long, only L. S, only S. Short, only. Or both. 4 seconds left. It's real simple. L long, S short, and that means only. B both. In other words, you draw a region box and you let it go either way. 3 seconds. Get your answer in. L, S, or B. 2 seconds. This box you're trading the Russell tomorrow morning at 6:52 Pacific. That pops up and it looks just like that. What would you do? 1 second left. Get your answer in. Last trade of the morning, our evening webinar here. Make your call. Time's up. Now, in this condition right here, and given the fact that you're only 22 minutes into the trading session, what did we say to do with region boxes? Did we say that you should have a bias? Is that what we said? We said you should have a bias in the first half an hour to hour of trading. You want to be biased. So you want to look only at one side of the market. So our bias would be down. The heck with going up. We're in a downtrend. Give me some shorts. Bring them on. Bring them on. Well, let's see what happens. Okay, here's 6:53. Uh-oh. Wait. We talked about the down thing. We talked about the down. This is not the down thing. Let's look at a couple more bars. Oh, this is not good. Where's my short? What happened here? You were supposed to go down. You're supposed to do this. The correct answer was both. Both. You wanted it to let it go either way, and it turned out if you did both, you were never filled short here. It never filled short, and you were long on depending on where you exactly how and when you drew the box on the close of one of those bars right there. You were filled long with a market order, and this turned out to be quite a good trade too. Because watch what happens is it comes all the way back up to where it broke down. Now, after that pop-up, was there any other long trade entries? This is the last question. I'm stopping the recorder. Last yes or no question. After the thrust move from this box right here, going into 6:57, 6:58, 6:59, 7 a.m. Pacific, were there other long trade entries, yes or no? You don't have to say where they are. Did it happen? Wiring in. 4 seconds. You should be spotting and seeing these, yes? I mean, if you do enough of them, you get like a rote memory thing in your trader mind, and you just start to see them. 2 seconds. 1 second. Yes, you can start going sideways to up, and there is another trade entry number 2 long. And pull in a thrust, nice trade, pull back, sit on the midband, textbook midband trade, Bagonga, long number 2. Technically long number 3. The original was down here.